Gold, a metal that has captivated humanity for millennia. From the ancient Egyptians to modern-day investors, gold has been a symbol of wealth, power and stability. It has served as a monetary standard, a safe haven asset, and a source of both fascination and frustration. Today, gold stands at a crossroads. Its price is locked in a trading range, hinting at a potential breakout but lacking a decisive catalyst. Currently, gold is trading within a well-defined range, bound by support and resistance levels established over recent months. This consolidation phase reflects the uncertainty gripping the global economy and financial markets. Investors are weighing the potential for inflation against the specter of recession. They're grappling with geopolitical tensions and the long-term implications of excessive debt levels. This period of indecision is not unique to gold. It is a common phase in the life cycle of any financial asset. What makes gold particularly intriguing, however, is its historical significance and its potential to act as a barometer of broader economic trends. As we delve deeper into the technical and fundamental factors at play, we can begin to unravel the complexities of gold's current predicament and anticipate its next move. The outcome of this tug-of-war between bullish and bearish forces will likely have significant implications for investors across all asset classes. Understanding the dynamics shaping the gold market is therefore essential for navigating the challenges and opportunities that lie ahead. To comprehend the current state of the gold market, we must turn to technical analysis. This involves studying price charts and indicators to identify patterns and trends that can provide insights into future price movements. Technical analysis is not about predicting the future with certainty. Instead, it's about understanding probabilities and managing risk based on historical data and market behavior. One of the most striking features of gold's recent price action is its consolidation within a clearly defined range. This zone, bounded by support at the lower end and resistance at the upper end, represents an area where buying and selling pressure appear to be in equilibrium. The longer gold remains within this range, the more significant a breakout in either direction becomes. Resistance levels, marked by previous highs that the price has struggled to surpass, act as barriers that require significant buying pressure to overcome. Conversely, support levels formed by previous lows, where buying interest emerged to prevent further declines, represent price floors that would necessitate substantial selling to breach. These levels are not arbitrary lines on a chart. They represent psychological battlegrounds where bulls and bears engage in a constant struggle for control. By carefully observing how gold interacts with these key levels, we can gain valuable clues about the balance of power between buyers and sellers. This information, combined with other technical indicators, can help us anticipate potential breakouts and make informed trading decisions. Price action, the movement of an asset's price over time, is the most fundamental aspect of technical analysis. It is through the study of price charts, particularly candlestick patterns, that we can begin to understand the forces of supply and demand at work in the market. Each candlestick tells a story, revealing the sentiment of buyers and sellers during a specific period. For example, a long green candlestick suggests strong buying pressure, as the price opened near the low and closed near the high. Conversely, a long red candlestick indicates selling pressure, with the price opening near the high and closing near the low. Doji candlesticks, characterized by very small bodies and long shadows, often signal indecision or a potential reversal in the market. However, price action alone does not tell the whole story. Volume, the number of shares or contracts traded over a given period, is an essential confirming indicator. High volume during price advances suggests strong conviction among buyers, while high volume during declines points to aggressive selling. Conversely, low volume during price moves often indicates a lack of conviction and potential for reversals. By analyzing the interplay between price action and volume, we can gain a deeper understanding of market sentiment and the strength behind price movements. For instance, a breakout from a consolidation range accompanied by high volume is generally considered more significant than a breakout on low volume. This is because high volume confirms strong participation and conviction from market participants, increasing the likelihood of a sustained move. In this chapter, we will explore the historical significance of gold in different cultures and its impact on economies throughout history. Gold has always held a special place in human civilization, from the ancient Egyptians who adorned their pharaohs with golden artifacts to the Roman Empire, where gold was a symbol of power and wealth. Gap 2S. Moving eastward, we find that gold was equally revered in ancient China and India, where it was not only a sign of prosperity but also played a crucial role in trade and commerce. The Silk Road, one of the most famous trade routes, saw gold exchanged for spices, silk, and other valuable goods, linking east and west in a web of economic activity. Gap 2S. In medieval Europe, gold became the cornerstone of monetary systems, with gold coins circulating as the primary form of currency. The discovery of the New World brought about the Gold Rush era, which had profound economic and social impacts, driving migration and settlement in previously uncharted territories. Gap 2S, gold's allure extended beyond its economic utility. It also served as a strategic asset during times of war and peace. Nations hoarded gold to back their currencies and strengthen their economies, often using it as a means to secure alliances and fund military campaigns. Gap 2S. By understanding the historical context, we can gain insights into the current dynamics of the gold market and its potential future trajectory. The legacy of gold as a universal symbol of wealth and stability continues to shape its role in today's global economy. Whether as a hedge against inflation, a safe haven in times of crisis, or a strategic investment, gold remains as relevant as ever. Gap 2S. Join us as we delve deeper into the rich history of gold, uncovering the stories and events that have cemented its status as one of the most valuable and enduring assets in human history. In this chapter, we will analyze the role of central banks in the gold market. Central banks have long been pivotal players in the global economy, and their actions significantly influence the gold market. Central banks use gold as part of their foreign exchange reserves, viewing it as a safe and stable asset that can hedge against economic uncertainties and currency fluctuations. By holding gold, central banks aim to diversify their reserves and protect their country's financial stability. The buying and selling activities of central banks can have a profound impact on gold prices. When central banks purchase gold, it often signals confidence in the metal's future value, leading to increased demand and higher prices. Conversely, when they sell gold, it can create a surplus in the market, driving prices down. Additionally, we will examine the relationship between gold and fiat currencies. As fiat currencies are susceptible to inflation and devaluation, gold often serves as a hedge against these risks. The interplay between monetary policies and gold's value is complex and multifaceted. For instance, when central banks implement expansionary monetary policies such as lowering interest rates or increasing money supply, gold prices tend to rise as investors seek refuge in the metal's stability. Through understanding the strategies and actions of central banks, we can gain deeper insights into the gold market's dynamics and its responses to global economic changes. Join us as we explore the intricate relationship between gold, central banks, and monetary policies, unraveling how these elements collectively shape the gold market's landscape. In this final chapter, we will look at the future prospects of gold as an investment. As we venture into an era marked by rapid technological advancements, environmental concerns, and evolving investor preferences, the landscape of gold investment is poised for transformation. Technological advancements are reshaping the way gold is mined, traded, and even utilized in various industries. Innovations in mining technology can lead to more efficient extraction methods, potentially increasing the supply of gold. Meanwhile, blockchain technology is revolutionizing gold trading, providing greater transparency and security in transactions. Environmental concerns are also driving changes in the gold market. The growing emphasis on sustainable and ethical mining practices is influencing how gold is sourced and processed. Investors are increasingly considering the environmental impact of their investments, and this shift towards sustainability could affect gold's appeal and market dynamics. Changing investor preferences are another crucial factor to consider. As younger generations enter the investment landscape, their values and priorities are shaping market trends. Millennials and Gen Z investors are more likely to prioritize sustainability and social responsibility, which could drive demand for ethically sourced gold. Additionally, the rise of digital assets and cryptocurrencies presents both competition and opportunities for gold as a traditional safe haven asset. By evaluating these trends, we can make informed predictions about the potential opportunities and challenges that lie ahead for gold investors. Will gold continue to hold its allure as a hedge against economic uncertainties? How will technological and environmental shifts impact its value? Join us as we explore these questions and more, delving into the future prospects of gold as an investment.